Good morning from London. I'm Anna Edwards alongside Guy Johnson and Lizzy Burden. We're an hour away from the opening trade. Here's what you need to know. Retreat from the risk rebound. Global stocks and futures are in the red, whilst gold and silver continue to surge. Trade tensions still in focus. China sanctions the American units of a South Korean shipping giant and threatens further measures. And Samsung reverses gains despite an initial jump on results that showed AI-driven chip demand.
Well, Anna, the risk-off mood is rippling through these markets. You can see futures pointing lower on both sides of the Atlantic this morning. That hesitancy that Trump will chicken out of those 100% tariffs on China now ramping up. We've got Treasuries back, Japan back from holiday, Columbus Day off. So the 10-year Treasury yield now at 402.63. And we're keeping an eye on precious metals, the debasement trade there in the background through all of this. The countdown to the opening trade starts right now.
Trade War Tuesday. Good morning. It's back, it's on the agenda, and it looks like it's having a market effect. You've already seen futures moving lower stateside. Keep an eye on them this morning. We haven't filled the gap left by Friday's sell-off with that rally Monday, and we're rolling over again now Tuesday, so we're not exactly signalling all clear right now. Yesterday felt like a bit of a dead cat bounce. What happens this Tuesday, I don't know. Is Powell going to rise to the rescue a little bit later on? He's delivering a big policy speech later on. Is that Fed story going to come to the market rescue as the session progresses? The story, though, is definitely around what is happening with the trade war. And Lizzy, it was there Friday. Yesterday felt like a bit of a reprieve. This morning, it feels like it's back with a bang.
Yeah, look, I was encouraged this morning when I saw the Wall Street Journal and all these sources citing both sides, the US and China, that really they do want to get a deal. That, you know, Trump doesn't want the Gaza peace to be overshadowed by the market turmoil. Yep. China does want to see a Trump-Xi meeting. It all seemed to me to be a bit of choreography. And then we had China threatening more retaliation against US curbs on its shipping sector.
Yep.
And we had Bessent, the US Treasury Secretary Scott Bessent, saying that China's trying to hurt the world's economy and wanting to pull everyone else down with them. So the market feeling that mood and pointing south when it comes to
Does this feel like we're just going to get more and more of this as we work our way towards a still possible, say probable, Trump meeting? If that's still on the agenda, then do we just get more of this posturing, more of this setting out your positions ahead of that kind of encounter?
What is interesting is that tech has done well through this, actually, the last couple of days. So to your point, where are the sensitivities in this? Because clearly US tech rebounded yesterday. That felt like Broadcom to me. I think you can kind of park that story. It filled the gap. But there is clear sensitivity within the US tech sector to what is happening here. And this trade war story with the rare earths, shipping part of that narrative as well. The US, the Trump administration feels super sensitive right now. It didn't take much, to your point, Friday, for the Trump administration like, whoa, just calm down here, folks.
I mean, this is based on no...
easily offended.
This based on no intelligence. I wonder if that was Norway driven, you know, but we don't know. As in the Peace Prize. And whether there was a sort of lash out. That's based on nothing. But I'm just saying that there could be much more of this as an unpredictability around this relationship as we head towards an encounter.
The Chinese are figuring out so much about the Americans right now. The sensitivity to the stock market is enormous. The sensitivity to the AI boom is enormous. And they're learning that lesson at the moment, that it doesn't take really very much. Just a little tweak here and there in terms of the rare earth story, and boom, you get a really big reaction out of the US, which tells you a lot about the sensitivity going into that meeting, if it happens, and how the Chinese are going to play it, which I think is fascinating at the moment.
And you, no doubt, talked quite a lot yesterday about the sensitivity of markets around that story Friday into Monday. Let's talk about the broader markets then, because I wrote down here, similar to you, Lizzy, I was feeling all good a couple of hours ago. I wrote down here, risk rally on pause. And now you look at US futures, E-mini's down 0.6%, NASDAQ futures down 0.8%. This feels like more than a pause. This feels like a sort of retreat from that rally a little bit. Morgan Stanley's Mike Wilson warning there could be an 11% drop in stocks if there is no resolution on the China-US front before we get to the next deadline. Because let's remember, we've just got this rolling deadline to not impose greater tariffs between the two, and the next one is in November sometime. So that's sort of hanging over the markets. And then you add into that the rally we're seeing in these precious metals and to some extent crypto, although that's not the story this morning.
Over this morning.
And so this whole debasement theme starts to come back into the market's thinking.
Bitcoin down 2.6% this morning. 112k per token is where we trade right now. I mean, the debasement trade is the thing that's in the background, but I think that this is a much longer story than the tariff worries. It will go beyond November the 1st, and also Trump saying that, you know, so much could happen by November the 1st. But it's that bigger worry about sovereign debt and therefore the move away from that and from currencies into the likes of gold, as you can see on the screen, on that screaming rally. This is something that will go on for years beyond the tariff.
But is it just a speculative? Is gold just a speculative rally now? We're putting this kind of wrapper around the debasement trade. It's structural. It has kind of underpinnings.
It's got thought.
Precisely. There's something to it.
Yeah.
Is it really?
I mean, SocGen's out with another target, 5,000 now. So,
but increasingly, is it just part of the speculative story? Is this? It's different as much as what was interesting is gold didn't go down as everything else did. But is there? Is this really structural? William Boyter was out with a nice note yesterday talking about, haven't heard from him for a while, talking about the fact that the central bank should be selling into this because it's got to the point where it is not speculative. It's not kind of structural anymore. It's speculative.
If you're worried about one bubble, maybe you just create another one in the meantime. So if you're concerned about AI, but it is creating movement in stocks associated with gold. I was looking at this from Bloomberg Intelligence saying that stocks with direct exposure to gold's rise have outperformed the median AI stock by more than fourfold this year. I mean, we're talking very different size, you know, the AI trade, those stocks associated with the AI trade, no doubt much bigger than those associated with gold, but those gains are incredible.
Fresnio was up 9%.
Yeah,
do you not notice every day I do Fresnio is a 52-week high? It's like almost on a daily basis.
We are listening.
But just on the point about silver and gold, because Tom McKenzie was pointing this out just before, you know, you've seen both on this rally, but coming back to central banks, silver doesn't have that anchor of the central bank holdings, and you've got this squeeze in London of... silver bars being flown back to London because of the lack of liquidity here. Maybe that broad debasement trade does actually start to separate the wheat from the chaff, shall we say, and you lose some but keep gold.
Maybe.
Don't know.
Should we talk about tech?
Let's talk about tech. Tech feels like it's like a straightforward story compared with some of the other stuff that we're watching at the moment in terms of gold and silver. Tech did fill a gap yesterday, which was interesting. So we saw the drop yesterday, but the tech sector did actually come back and fill that gap, which I thought was a fascinating trade, in as much as the wider market didn't. You got another open AI story, which I don't understand, and how they're financing it and funding it.
Tom.
Don't understand. Honestly, read Jonathan Levin's piece in the opinions. It is brilliant in terms of his tracking of these deals that OpenAI is doing and the kind of the financing that go or kind of where the financing is coming from, which I'm not sure he understands either.
No, but he's the man you need at moments like this.
Honestly, his writing is masterful at the moment. I am enjoying every morning reading what he has to say. So just kind of pick up on that. But Broadcom rallied massive yesterday, and that, I think, allowed the tech sector to do what it did yesterday. Samsung, I think, is fascinating as well this morning. In as much as the Samsung results are good, and the high bandwidth stuff looks really positive, and the numbers they're generating are really good. But you have to see it in the context and the light of this big rally that we've seen in the stock. And what I think is interesting is that Asian investors are saying, yeah, OK, we'll take a bit of that. We're going to take a few chips off the table, and we're going to take some of our money back because we've had this great rally. So it's better to travel than arrive. And we've got to the arrival point, and it all looks great. So let's lock in a few gains, which I think is an interesting different mindset to what we see in the States, where it's just like up, everything goes, and there's no point at which you want to take profits because any dip gets bought really quickly. And there's just this different mindset that's emerging in terms of the way the stocks are being treated and the AI trade is being treated in the States to the way that it's maybe being treated elsewhere around the world.
The thing that raised my eyebrow this morning on the tech front was I was looking at all this stuff happening ahead of Nvidia earnings and then thinking, oh, when is that? November 19th.
ASML's tomorrow, though.
OK, so ASML's tomorrow, but then we will spend until November 19th saying we must wait for Nvidia earnings, which is a very, very, very long time.
And TSMC on Thursday in the meantime.
Yep. So there's plenty still to come in terms of that story and plenty of updates. But I think the way that market is reacting to Samsung today, I think, is really interesting in terms of the narrative.
Shall we talk a little about UK data? We've got some wages data, and I was all ready for this to paint a stabilising picture. That's what the chat had been about, you know, before the numbers dropped. But actually, this average weekly earnings, so this is wages essentially, 3 months, year on year, coming in quite punchy, quite high. So do we have another wage issue to worry about in the UK? It's up by 5% against an estimate of 4.7%. end. Bloomberg Intelligence, ahead of this number, was saying that we're not going to get any movement from the Bank of England until spring 2026. You know, does this put cuts further away if we're seeing wages coming in quite punctually? The pound is dropping, though, interestingly, this morning, down 0.2%.
6 basis points of BOE cuts had been priced in before this data, so we'll see where bets go at 7:30 when they open.
Do you want to ride the curve? That's what our next guest is going to tell us that we should be doing. It's been the theme all year for Allspring Global Investments. Laurent Van Billon is going to be joining us very shortly to talk about that. Head of FX and rates over there. Evie Hambro is going to be joining us from BlackRock. We are going to be talking about the gold trade with him, the silver trade with him, the precious metals trade with him. Kate Moore's on this side of the Atlantic, City Wealth's CIO. Looking forward to talking to her. And Elsie Susie Watts, Global Digital Finance Executive Director. Here to talk about what is happening in crypto. Friday was ugly, and to be honest, it's continuing to be pretty ugly this morning for the crypto sector.
Here's what's on the diary for today. At 10 a.m. London time, we get the German ZEW survey expectations. Then we've got Wall Street bank earnings kicking off. JP Morgan, Goldman Sachs, Citi and Wells Fargo. Then at 5 p.m. London time, LVMH sales data drop. And at 5:30 p.m, we hear from the Fed chair himself, Jay Powell. But really so much focus on US earnings because we don't have the economic data right now. And particularly when it comes to the banks, that credit data, the nearest thing we're going to get to official economic data, apart from the private sector.
But they're making good money, and you wonder what kind of volatility this earnings season is going to throw out and how important this earnings season is going to be in terms of telling us kind of whether or not this rally could continue. At its base, this stock story should be driven by earnings. Is it going to be driven by earnings is the question now.
Yes, and in terms of the earnings and the drivers behind those earnings for the banks, we'll talk to Charlie Wells, I think, later. He'll give us a preview. But trading revenue expected to be good. Rebound in deals. You know, if that was one of the negatives around the Trump administration was so much uncertainty, deals can't get done. Well, has everybody managed to put aside that uncertainty and just think this is some kind of new normal, we just got to get on with it? And there is a sense that some deals are coming back. And maybe with the Trump administration, you get that weaker regulation environment. Maybe that is something that the banks will talk about a little bit as well.
I am looking forward to LVMH as well. Really going to set the tone for the luxury sector. It's been, for followers, dedicated followers of fashion, a very exciting season with all the new creative directors. So we look to that, but of course so dependent on China. And being such a giant LVMH, not the best setup necessarily in an environment that's wobbly like this.
Absolutely. Stock market, very strong. You've seen that in Delta earnings. People are spending money on travel. Do they spend money on luxury and all the other good things that you're talking about and know more than I do about? Anyway, let's talk about what else we need to know this Tuesday morning. President Donald Trump used his one-day tour of Israel and Egypt to soak up praise from fellow leaders and lay out a vision for a broader Middle East peace. This after the success of the US-led mediation efforts to end the fighting in Gaza. Speaking in the resort city of Sharm el-Sheikh, Trump signed the Gaza agreement that he said had taken, get this, a mere 3,000 years to reach.
This is the day that people across the region and around the world have been working, striving, hoping and praying for. They have done things over the last month that I think were really unthinkable. Nobody thought this could happen. With the historic agreement we've just signed, those prayers of millions have finally been answered.
Japan's main opposition parties are going to be meeting today, very shortly in fact, as they weigh the possibility of rallying behind Yurichiro Tamaki as the unifying candidate to take on the ruling party leader Sane Takaichi in the parliamentary vote to decide who will be the next prime minister. The meetings come after, of course, the shock collapse of the ruling coalition on Friday. And Sébastien Lecornu will address the French Parliament for the first time since being reappointed as Prime Minister a little later today, as his fledgling government tries to pass a budget which will be presented to the Cabinet this morning. President Macron has called on the fractured Parliament to deliver stability for the country rather than precipitate another government collapse.
Sounds like a hope and a prayer to me.
Yeah, there's a definition about kind of doing the same thing over and over again and expecting a different outcome. Are we going to get a different outcome this time around? I don't know. We're going to see another budget. The cabinet's changed a little bit, but is it enough to satisfy? Well, we know it's probably not enough to satisfy the right. Can the left get on board with this? I don't know. Or by the end of the week, will we have a new government?
There's certainly a lot of political turmoil from France to Japan to drive that debasement trade conversation, at least, if that's what we're into these days. Worrying about the sustainability of fiscal budgets everywhere, certainly in those two places.
The US government's still locked down.
That, by the way, sorry, forgot to mention.
In the US, France and Japan, politics just so far removed from the fiscal reality, and no one being able to get something through, and yet the market not forcing governments to come to their senses and be fiscally responsible.
Where are those bond vigilantes? We're watching. Let's tell you what is coming up on the programme. Coming up, Airbus opens a new facility stateside as the world's largest plane maker looks to clear a massive backlog. We'll get details shortly. Plus, we'll preview ASML earnings as Europe's most valuable company reports earnings in less than 24 hours. Up next, it's risk off for markets. We will discuss that, of course. If you want to get involved in any of those conversations, IB plus BBTV Go is the function on the Bloomberg terminal. This is Bloomberg. Welcome back. This is the opening trade, 7:18 here in London, so 40 or so minutes until the start of equity trading. And you can see sentiment has turned. We are back to not the extent of Friday, but back to Friday's negative sentiments at least. US futures also pointing lower, down by 6 or 0.8% on E-minis and Nasdaq futures. Now, investors may be seeking to protect themselves from threats posed by runaway budget deficits through what's become known as the debasement trade. We were just talking about France, talking about Japan. Let's bring in Bloomberg's Nora Melinda, who is visiting us from the US TV team. Nora, good morning. She has details. Good morning to you.
Well, good morning, Anna. Seeing a lot of activity right now in the market. Of course, you are seeing some weakness here in S&P 500 futures. This is a pullback, of course, from the rebound that we saw at yesterday's close in New York City. And this, of course, was the rebound that we saw from the large sell-off that we saw on Friday here. But if we're looking at digging a little bit deeper here, of course, the story really is about the debasement trade here. So you are seeing fears that the U.S. is spending too much. Debt is potentially ballooning. So you're seeing a lot of traders trying to find a safe haven right now in this environment. If you move over to look at the U.S. dollar, of course, we're looking at the Bloomberg dollar spot index here. We're seeing, of course, a little bit higher right now as we speak. But, of course, you are seeing a lot of traders also running toward gold. If you look at what gold is doing right now, we are seeing a flight to safety, gold being, of course, a safe haven here for a lot of traders in this environment. But, of course, we have bank earnings today kicking off, earnings season over in the United States. But Powell, of course, Jerome Powell, set to speak later today. So it'll be a lot to digest here for U.S. traders as we kind of think about what the path looks like moving forward with the Fed meeting scheduled for later this month. Over to you, Guy.
Linda, thank you. Nora, thank you very much indeed. Nora Melinda joining us. Talking about the debasement trade, talking about Powell later is going to be one to watch out for. Is it 520? 520 is going to be talking. Looking forward to that one. Is gold the new treasury market as well? Is that the right place to be hanging out? There's lots of questions this morning around the bond market, but bonds have played a slightly different role over the last few days, maybe back to being that safe haven trade. Our next guest, though, says despite the debasement trade, bond investors can still, quote, ride the curve and make a bit of money. Laurent Van Billon, Rates and FX Senior Portfolio Manager at Allspring Global Investments, joining us around the table. Good morning.
Good morning.
How do I ride the curve?
Riding the curve is all about finding the right part of the curve, as in that right risk-reward on the duration side of things.
Yep.
Where are you getting the most bang for your buck?
Where is that?
Right now, I think it's still the kind of belly to the short end of the curve.
Yep.
I think that long end has been a difficult trade all year. We've been looking for curve steepening all year, and it's played out really well. That 3 to 5 year has been working really well. I think maybe now, though, we're shifting even shorter.
Why? Okay, why are you shifting shorter?
So I think there's a couple of things happening there. What does work really well for US investors who are looking for a little bit more yield, perhaps, from their sovereign bond markets, is you can buy ex-US securities and hedge them back to hedge the currency back to the dollar.
Okay.
And with that US interest rate being amongst the highest in developed markets, you get that pickup in carry, in running yield.
There's a carry trade and getting short. Okay.
Can I present an economist's fantasy scenario in terms of the UK? I know you don't like the long end of gilts, but lots of economists talking about how Rachel Reeves should create loads of headroom, whether that's through raising taxes again or cutting spending more. If she happened to take that option, would that make the long end of the gilt curve attractive to you?
I mean, everything's attractive at the right price. Absolutely.
Okay. So,
if the fundamentals change significantly and all of a sudden, yes, there was this amazing fiscal headroom and we were confident that inflation was sort of stable at the 5-year horizon, then
how do you think we get this amazing fiscal headroom?
Well, as I say, all the options are politically difficult, but every economist seems to, and think tank seems to be calling for it right now. That she
raising taxes.
Yeah, break her fiscal rules, abandon her manifesto pledges, just so that we don't have to keep going through this turmoil every single time there's a budget. But it'd be nice for Rachel Reeves to hear that maybe it could make gilts more attractive.
If we change the reality of the UK spending conundrum, then yes, absolutely, the outlook for gilts can change as well.
We were hearing from Nora about the debasement trade, and I want to pick your brains on that then, Lauren, because, and to Guy's point, he was yes, the debasement trade might suggest that there'd be less appetite for treasuries and that yields might go higher. But then on Friday, when we saw turmoil in equities, actually treasuries acted a bit as a haven, as if maybe they're not part of the debasement trade and they can stay. What is your thinking around the role that treasuries are playing right now?
Yeah, but that Friday reaction was interesting because it was right back to the, OK, trade shenanigans, downside growth risk. Let's try and price for that. I think treasuries are an interesting spot right now. There's quite an aggressively priced US easing cycle in the market right now. And maybe that's the 2-year that's sort of the best place to benefit from that.
And you don't think we get it all? We don't get allll of that easing cycle?
Is that
or
because,
you do?
CPI's expected for 3.1%.
Well, who knows? Who knows? For a data-dependent Fed who's having to make decisions on absolutely no official data, that is a difficult place to be. But I think if you look at the risks, on the balance of risks, what's the risk here? That we get more easing out of the Fed than what's currently priced in, or less? And I would say it's to less.
Mm. Don't you think, though, that the last few days have told us that actually the market is more now concerned about the growth narrative than the inflation narrative? And I hear what you're saying about the fact that the inflation might be sticky up here. But what was interesting is that when, and Valerie's been talking about this, when we went through the tariff turmoil Friday through the weekend into Monday, the market reacted as a growth shock concern rather than a tariff inflation shock concern, which they did back when we had Liberation Day. There was an inflation shock concern at that point. But now it's just a growth shock, and that, in theory, takes treasuries into a better place.
Yeah, it's a good point, because absolutely that reaction was classic downside growth shock.
Yeah.
But maybe that's coming because we've already seen a couple of cracks in the labour market.
Yeah.
Maybe it's telling us something about the Fed makeup into next year, right? Under the new governor.
Yes.
It could be telling us all sorts of things. I still worry about that gap between market and consumer expectation. That to me, I think, is something to keep a real close eye on into next year.
I mean, right before Friday, you had Ray Dalio warning about spiralling government debt. You had Ken Griffin saying that investors were rushing to gold to reduce sovereign risk. So I wonder whether you just kind of put those concerns to the back burner now that we've seen Friday and Treasury's rallying.
I think this bid for gold that we're seeing, it kind of speaks to that wider idea of investors looking for diversification, right? So you don't want to be, never mind just one asset class, just in one geography. So it's looking globally, it's looking across as many asset classes as possible to find these sort of pockets of value or where you think might altogether build a really resilient portfolio.
Speaking of that, just briefly, Lauren, any chance of a sustained dollar rebound? I mean, it's not weakening as it was earlier in the year. I know Standard Chartered have been talking about a productivity boost for the US with all this AI creating a dollar rebound. Do you see that coming?
I think a lot will depend on the pace of that rate cut cycle, as we spoke about. If it goes sort of as we expect, the dollar, then maybe it's more about hedge ratios or it's about, productivity could absolutely play a role. If we see a Fed that's sort of more aggressive, that to me says that the dollar could be sort of have another leg weaker rather than stronger.
And maybe if we see the end of the government shutdown, day 14 today, maybe if that ends, will help the dollar out. Lauren, good to see you around the table. As always, Lauren Van Biljon, Rates and FX Senior Portfolio Manager over at Allspring Global Investments. Plenty more to discuss. London Metals Week kicking off amid all these global silver and gold rallies. We're going to speak to BlackRock's Evie Hambro next. This is Bloomberg.
Where are we? 30 minutes to go until the start of trading in Europe this morning. US futures have been rolling over all morning, I have to say, and it's a similar narrative that we're seeing here in Europe. Stocks 50 futures are down by 0.6%. Let me just take a quick look on my Bloomberg terminal to see exactly where E-minis are this morning. Yeah, we're down by 0.6% there as well. The Nasdaq is down by 0.8%. So equities are once again under pressure. We didn't fill the gap from Friday. which is interesting. We rallied a little bit yesterday, didn't feel convincing. We didn't close the gap with where we started Friday morning.
Should we check in on the bond space? You're looking at yields lower across the curve, across the European continent. The 10-year bund yield down 4 basis points at the moment. 2.59 is where we trade. French oats bunds, the oats bund spread, I should say, is at 84 basis points. But, of course, we're waiting for the renewed Prime Minister Sébastien Lecornu to present that budget to the National Assembly later, so we'll see how much compromise is on offer. That will go to the Cabinet, and we shall see how the spread reacts there.
Not too much of the pain from the Japanese political turmoil spreading through this morning into Europe, which is perhaps a relief. We saw yields going higher there. Let's move on to precious metals and what has been happening. I've got some 5-day charts for you because these tell the story of the rise, although this morning tells a slightly different picture. But we've got 5-day gold chart for you. Real strength coming through in the gold price, of course, for a host of reasons we've talked about many times. SocGen out with a new target now, $5,000 a troy ounce. Let's show you the silver price. That also showing strength, the highest price in decades on silver. But in today's session, we've been on quite a journey. We were up 2% at one point, down 1%. We're now down 2%. So a lot of volatility, let's put it that way, in the silver price this morning. It is London Metals Week. I wonder if the two are related. Evie Hambro joins us, BlackRock's global head of thematic and sector investing, and somebody we turn to explain to us what is going on in metals. We were just talking in the break about reading stories that talk about gold bars being shipped from New York to London, and it's at those moments where the rest of the investment community calls you in, Evie, and says, what on earth is happening here? So let's start with silver, the highest price in decades, and some sort of squeeze in London, a short squeeze in London, fears about low volatility. I thought all the talk was about higher precious metals prices, so why were people short? Explain to me what's been going on here.
Well, I think in all commodities, there's a difference between the price on the screen and the physical action that's taking place. And what you're describing is the movement of material to meet a contractual commitment. So if somebody is short physical, then physical's got to be moved from A to B to be able to unlock that thing. Does that have an impact on price? Maybe. Does it have an impact on lease rates? Definitely, because you're going to have to borrow to get the material. So I think what we're seeing in something like silver is just a mismatch maybe with some of the paper contracts relative to the physical positioning. I don't think it's necessarily anything to do with the price is too high or the price is too low.
I mean, so is this the way that the silver market is supposed to work, Evie, that gold bars are incentivised to fly from New York to London at certain periods, you know, due to certain price dislocations? That doesn't sound... Is that the design?
I don't think it's necessarily the design. You obviously want an efficient market. You don't want to have any of these additional costs. But, you know, it's not the first time we've seen this. There's often been mismatches in contractual positions. So, you know, the gold market lease rates in Asia spike in certain periods of time where there's a physical shortage relative to, say, a derivative commitment. So it's kind of normal. The rates are high and elevated, which means the physical positioning is out of a bigger balance, you know, relative to what should be happening. So it's not something that... It's exciting, put it that way.
Anna bigged you up as delivering wisdom.
Oh, my God.
I know. Expectations are high. What is going on? Is there something bigger happening here? You kind of sat down and had the kind of teasing lines kind of about fiat currencies and gold and repricing. And is that what is happening here? Or is this just a realisation that central banks around the world, post-Ukraine, don't want to hold assets that can be seized, and therefore we've started something that's kind of spinning for... what is the Evie Hambro wisdom on what is going on with the gold trade, the precious metals trade? I guess,
well, one of the wonderful things about LME Week is that you get to have fantastic people, much wiser than me. You should be getting them on here. I find that hard to believe. Yes. And you get to spend time with them, and you learn. So I was at a dinner on Sunday night, and early dinner on Sunday night, of course, and listening to some, you know, incredibly savvy people on markets. And one of the things that piqued my interest was the vocabulary that people were using to describe what was going on. And I've been used to saying for a long time now about allocating away from the US dollar debasement, damage to paper currencies, fiat pricing, etc. All of these things. And you wrap it all together, and it's very difficult to describe succinctly. And one of the people in the room said, actually, I totally agree with all of this stuff that's been said, but I think it's bigger than that. I think it's more about, aversion to paper currencies. And it's the trade away. So it's a trade away from the pound. It's a trade away from the dollar. It's a trade away from the euro. And you can extend this. And then you think, well, what's actually behind that? And you don't want to stray too deep into politics, But you look at the balance sheets of governments around the world, there's a lot of debt. The interest cost is rising very, very rapidly. You were talking about it. Before this. Then you look at the kind of entitled social burden that many countries are facing. That's an enormous liability. It's a bill for the future. And, we're borrowing today to pay this bill. So we're borrowing against future growth and future population. That's damaging in confidence around how governments are managing economies. And I think that feeds into trust, which is the picture that you have to have strength of trust to have strong currencies.
I hear all that, and I wonder where the logical extension,
exactly.
Where's the
end, dangerous bit.
Where's the end point of that kind of narrative? And how much of what we're seeing at the moment is just momentum? There's a momentum trade, speculative kind of trade around this. I understand the kind of theoretical underpinnings of it, and I worry about where it takes us. Yeah. But I do wonder in the short term whether or not we're kind of getting ahead of ourselves, and there's a lot of momentum behind a trade that is different in its nature. The underpinnings of a lot of people putting this trade on is different in nature to what you're describing.
Yeah. And there are different ways to look at it, and so you look through it in some lenses, and you would be absolutely right. So our gold company is earning a lot of money right now. Absolutely, the margins are as fantastic as I've ever seen in my career. Yep. Is that a warning sign that the price is too high, and maybe costs will catch up, or are prices of gold still too low and they'll go higher from here? Right now you would have to say that just on that metric alone, gold companies are probably over-earning in terms of their profitability. When you then do the analysis and say, what does gold buy you? So what does gold buy you in real life? And we've done this analysis, we've shared it and things with
Don't
you
have
guys.
this conversation with my wife, by the way.
And, if you want to go and buy a Big Mac or burgers or low-value goods, you can buy more of them today with gold than you could have done in the past. But if you want to go and buy a pretty standard item, say in the US, like a Ford F-150 pickup, you can't. You're buying less of that, even at today's gold price. So gold has preserved its purchasing power for some items. It hasn't preserved its purchasing power for all items, like Manhattan property, the average property price in Manhattan. You can buy way less of that. So has it kept up with everything? No. So therefore, on that metric, excluding the first one, it's not overpriced, because otherwise you could buy everything with less gold than you could have done in the past. And so I think, you've got to look at these different metrics to decide where the price is itself. But I still come back to this trend, and you mentioned momentum. Momentum is very important here. So maybe you have some speculators riding on the journey in the interim, causing volatility like we've seen today. And maybe some of this physical leasing is part of that. But actually the trend is probably your friend in this environment. And if we are going in this direction, hopefully slowly, we don't want to crash. If we are going in this trend, then where could it go to from here? It could go a lot higher if we're actually repricing paper currency relative to real assets, and there's an issue around people believing in it, then this currency aversion trade could last a while.
I mixed my commodities metaphors earlier and said that there'll be some splitting of the wheat from the chaff. But, with the debasement trade, does it worry you that it's kind of unspecific at the moment and this momentum is just driving at anything that isn't sovereign debt, that isn't currencies? And do you think that actually, Anna's talking about the silver bars and the shortage here in London, that actually, gold is the one you can rely on and some of the others will suffer in the future, the near future maybe?
I don't know. I've always said when I come on here that silver and gold are very different. Silver's an industrial commodity, solar panels and so on. Gold's a monetary commodity. And so they have very different dynamics that sit behind them. You look at the silver market today, there's something going on in the lease market. There's a shortage somewhere. Someone's paying to get hold of it to meet a commitment. That's all that is. It doesn't mean that the price is too high or too low or where it is right now. But I'm actually excited by the profitability of the underlying companies, which is what we invest in. And at these prices, these companies are earning like enormous margins, absolutely fabulous margins. Is that priced into the equities? And you might say, well, oh my God, Evie, the stocks are up 100% this year. How could they possibly be cheap? That's staggering. They've never been cheaper than they are right now. And we're starting to see the market catch up with that trade. I think last time I was on, I was talking about the average long-term gold price that people are using in their models was between 2,200 and 2,400. That's a big discount to today's spot price. That's that's like a 50% discount to the futures curve. That's a massive, massive difference. So the prices are now starting to be upgraded. So we've seen some of the sell-side analysts come out and say long-term pricing should be 2,800, 3,000. that's still a big discount to spot and a massive discount to the forward curve. So when you look at all this together and you say, what's priced into the equities? What's priced in is a massive retracement from today's prices. Yeah? And if that doesn't happen for 12, 18 months, 2 years, these companies will way over-earn relative to expectations.
I also want to ask you, back to London Metals Week, what the vibe was when the Trump tariff threat came along on Friday night. Was everybody in town? Did it kill the vibe? Did it change your thinking strategically at all?
Great question. So it doesn't really start until Sunday. So, it wasn't really much of a kind of atmosphere to engage with people there. So I think by the time we got to Sunday evening, J.D. Vance had come out and said things to kind of soften some of the volatility. Hence, we didn't have the big move on Monday in equity markets that was priced in on Friday night. So I think that comment had kind of calmed things down a bit. Yeah.
Gold always crashes, doesn't it?
Does it?
That's what history tells us.
You're the man with wisdom.
But I look at the long-term chart. It always goes up and then it comes down pretty hard.
Well, I think everything goes up and everything comes down and everything goes back up again, and that's a cycle. So, but I think what we're in right now is it's probably bigger than a cycle.
Yep.
Yeah, because we've got this enormous trend that's been with us now since the 1950s, the overprinting of paper currency. And this growing social liability. And I think it's so hard to break away from that. And eventually these things get to tipping points. And when you get to a tipping point, then things change. And maybe we're seeing a change in some of these real assets on the back of that.
When you get to a tipping point, things change. Wisdom from Evie Hambre. Thank you for stopping by. I know you have a busy week. It's great to see you so early in the morning. Evie Hambre, BlackRock's global head of thematic and sector investing. Coming up, we're going to take a look at Ericsson. The company reported a profit jump this morning. That and many more stocks on the move this morning. Keep an eye on what's happening with BP. The luxury stocks potentially could be on the move as well. There's lots going on. Retail out of the UK. Lots going on this morning. Stocks to watch next. This is Bloomberg. 14 minutes to go until the equity market open. Metals are rolling over a little bit. Equities certainly are under a little bit of pressure. And we're certainly seeing that stateside as well. So that's another factor you need to fold in to your thinking this morning. Part of this is down to what is going on between the United States and China. China threatening further retaliatory measures against US curbs on its shipping sector after sanctioning the American entities of South Korean shipping giants. For more now, we're joined by Bloomberg's senior editor, Balash Pens. Balash, so is this reciprocal? Tell us about it. What's going on? Is this a tit-for-tat kind of retaliation story? What do we know?
So Beijing announced a couple of measures today. One is that they're sanctioning the 5 U.S. entities, 5 U.S. companies linked to the South Korean shipbuilding giant Hanwha, basically forbidding Chinese companies from doing business with them. The other measure they did is a probe into the U.S.'s own investigations into the Chinese maritime sector. So like you said, it is a bit of a tit-for-tat measure, and it follows previous measures that were also in a similar kind of incremental nature, where they started charging port fees on each other's companies, and it's part of this kind of long-standing dispute over who rules the seas, who gets to build all the ships that forward about 80% of global trade. So it can have potentially very widespread implications for global trade, and that's what we see in the markets. That's what markets are reacting to. It was a very risk-on environment early on in the Asia day, and that has turned around completely, a complete 180 since then.
80% of worldwide trade, that really is significant. Balash, just walk us through how the ripple effects could transpire when it comes to the global economy.
Well, I think the biggest concern is how this might affect the broader trade relationship between the U.S. and China. Obviously, we had the very dramatic day on Friday, and it seemed like tensions were calming a little bit. There was a little more space for negotiation when we got the news over the weekend about J.D. Vance and Donald Trump kind of walking back a little bit some of those comments. One way to look at it is that China is showing that they have many different pressure points that they can apply when it comes to the U.S. It's not just about rare earths. Another way to interpret this is that they're trying to calibrate their response very carefully and trying to find ways to send a message that does hurt but does not completely break off the relationship and still leave some room for negotiation before the two leaders meet in Korea later this month.
Balazs, thank you very much. Balazs Pens with the latest on the tensions between China and the United States and how they're now playing out in the world of shipping. Let's take a step back and think about the markets in 3 minutes. Bloomberg Markets Live. Skylar Montgomery-Koenig joins us on the programme. Really nice to see you, Skylar. Thanks for joining us. So let's talk about the markets in 3 minutes. And let's start with the trade tensions. Is there anything more than headline risk here? Is there anything substantial to take away from the latest news flow?
Yeah, I mean, I think one thing that you need to put into context is that we're coming from very frothy valuations levels. So the past couple of days of trading action that you've seen, it makes sense that you're getting some kind of a sell-off on this news. Now, we can't say a lot about the headlines going back and forth. We know that that's kind of causing whipsaws within markets, but we can say is that there have been broad exemptions. And so when you think about the country level, those broad exemptions apply to Canada and Mexico. So Canada has an effective tariff rate. That's something like 3%, so that's quite low. Whereas somewhere like Europe, the tariff rate is quite high. There aren't exemptions. You're also having a very expensive currency. And so the worry then is export competitiveness. Now, on the sector level, there are broad tech exemptions. So as we head into earnings seasons, and it's more likely that the tariff impact is delayed rather than avoided, you need to think that they might not come for tech, the powerhouse of the U.S. equity market at all, because of those exemptions.
Can we talk about France for a second? Should I expect a different outcome this week to all the outcomes that have come before, which is we get a new government, new prime minister, we're full of hope, we're getting a second sort of go at it with the Lecornu, the current prime minister, and we get a budget over the line. Is that a realistic prospect this week?
I mean, it certainly could happen, and that is actually...
That doesn't sound positive.
Well, that's your best-case scenario, right?
Yeah.
And in that best-case scenario, you still have a debt sustainability problem. It's not like you're going to have fiscal deficits.
So there's a hangover that comes with that.
Yeah. Exactly, and so you need some kind of premium in OATs, and you need some kind of premium in the euro. And I think the issue is the market thinks the ECB will backstop the French bond market regardless of what happens. And, you know, there's a TPI instrument, but there are conditions on that instrument. We also haven't tested how far the ECB is willing to let spreads go. And, you know, if you have something like Macron resign, you could very well see that limit tested.
I don't see him resigning. I don't hear anyone. No one tells me that they see him resigning or the ECB intervening unless that spread was over 100.
He has a history of wild moves, though. Calling that election was unexpected and devastating.
That's true. I won't rule out surprises in French politics, but I take French politics and raise you Japanese politics because we're seeing some pretty wild moves out of the Japanese politics. And I do wonder whether that's more because of the collapse of the LDP coalition or more because of the worries about US-China, Skylar.
Yeah, I mean, I think there's just a lot of mess going on. And so when you're trying to kind of parse through what's happening, there's something that you should probably keep in mind. Regardless of who's actually going to govern Japan, the issue is inflation. Now, a weak yen is a consumption tax, essentially, and so it makes that worse. And so any kind of government that's coming to power, their incentive is to put a floor on the yen.
Okay, really good to have you. Bloomberg MLive's Skylar Montgomery-Koenig, now of the Bloomberg Parish. We love to see it. And remember, you can get up-to-date analysis and insight from Skylar and the rest of the team by going to MLIV Go on your terminal. Now let's have a look at the stocks to watch this morning with Chloe Melly. Chloe.
Good morning, Lizzie. Let's start with Michelin today. After last night, it cut its outlook due to really weak sales in North America. So it blamed, in particular, a slowdown in demand for trucks and other heavy-duty vehicles used in agriculture in that region. And it also said that, of course, U.S. tariffs did not help either. So we could see some further pressure on the shares today. It's already been underperforming its peer Continental and has been on the same kind of similar downward trajectory as its other peer over in the U.S., Goodyear. So let's keep an eye on that today. Analysts have said that this indicates potentially broader risks, broader weakness for that tyre market. So there's definitely a sector to be keeping an eye on as we move forward with this earnings season. Moving on to the mining sector, as the silver and gold rally is continuing as part of this broader debasement trade. Silver hit an all-time high because of this short squeeze in London and this flight towards safe haven assets. Gold is also up massively due to this rush towards those precious metals, and this is something that will benefit at companies like Fresnillo, for example, and other names in that sector. So Fresnillo is already up almost 300% over the last year. It's a gold and silver miner, and also some of its smaller peers, including Oshtal Mining and Endeavour Mining, will be ones to be keeping an eye on today as part of this debasement trade. And finally, let's end on Ericsson, which reported a massive jump in third quarter profit. A lot of that has to do with the sale of its core routing business, eConnective. It also announced a brand new network deal with Vodafone. So on the back of those positive news, we could see a jump in the shares this morning, some relief for Ericsson after a weak dollar and weak demand for 5G equipment really held back the shares over the last year. So let's keep an eye on that today at the open as well.
Chloe, thank you. Chloe Melly, equities reporter, with some of the stocks we're watching. I'll also throw into the mix BP. They're saying that their weak oil trading performance will hit the company's profits. And as you make the comparison, Guy, which is useful, Shell gave a quite bright story on their trading. So interesting if we see anything different coming through from BP this morning.
Yeah, also watching Publicis. Looks like that's going to be up. They had their earnings this morning, actually raising their outlook on strong ads and AI. And it's interesting because there've been all these warnings that, you know, when you've got the likes of Palo Alto Network making a AI campaign where you don't need the marketers anymore, that the likes of Publicis wouldn't be needed. But hey-ho, looks like they've done pretty well this quarter.
Can I just throw a bucket of cold water over everything?
Go for it.
US futures, Nasdaq's now down by 1% nearly.
Yep.
And continuing to fall, dropping fairly fast at the moment on the back of what we're seeing with China. S&P mini futures are down by 0.7%. Euro Stoxx 50 futures down by 0.6%. So in all of these single stock stories, that's the top down.
So even if we think it's all gameplay ahead of a Xi-Trump meeting, the market is going to ride that headline risk and take some of it seriously. We'll be back with the market open next. This is Bloomberg.
Tuesday morning, how are you feeling? A little worse than yesterday, probably. What we're seeing this morning is futures rolling over. What we're seeing this morning is a return of the trade narrative, which got the market so spooked Friday. Yesterday feels like a distant memory already and had something of the rubber cat about it. We bounced quite nicely, but we didn't completely fill the gap that we set ourselves up with on Friday. So that's what you need to think about as you think about what we're going to be seeing today. So the session yesterday in Europe definitely rolled off towards the end of the day. A little bit of a pop before we closed as the US market got into gear. The US market came up, but not by much. And then, to be honest, kind of drifted sideways. It felt unconvincing, Lizzie.
Yeah, well, when we look at the futures picture here in Europe, Guy, it's red across the screen. So that mood that you're seeing in US futures and in the Asian session here very much on show as well. CAC futures down 0.7%. Of course, we've also got the budget to be presented today by Prime Minister Lecornu. But maybe there's a bit more optimism when it comes to the single stock stories, Anna.
Well, we'll see, won't we? I've got a couple that might not be, well, one certainly that isn't very optimistic. Let's start with Ericsson, though. Maybe room for optimism there. Third quarter profits jumping. They've sold a particular business, iConnective. It's a call routing business. They've sold that, and so that's part of the third quarter profits narrative over at that company. Michelin in focus. There's fear here about whether this drops at the open. They've issued a profit warning, mainly due to a much weaker performance in North America. This from the French tyre maker, so we'll watch that one in Paris. And really fascinated to see what we see happen to basic resources this morning. Iron ore prices down by 2.5%. Steel down by nearly 1%. This all through the Asia session, and we've got weakness now for a change in silver prices, Guy, and given some of the silver miners went up by nearly 10% yesterday, we watch that sector.
Yeah. Is Fresnillo going to be on my 52-week high list today? That's what we're all waiting for at past, isn't it? I know. OK, here we go. Here's the market open. This is what we are seeing. We're anticipating a quite negative story. You've got the IBEX down by 0.4%. The FTSE 100 in some ways is going to be interesting today, in as much as you do have that mining narrative that I think is worth paying attention to, and I think that may protect it a little bit. It's going to be interesting to see how the oil trade works its way through, though, once we get BP and some of the other oil traders open as well. But yeah, now falling in line with, I think, probably more what we would have anticipated. But the 600 is down by 0.6%. That's pretty much in line. 6, 7, 8/10%, I think, is what futures were basically pointing to us to this morning. It's going to be interesting to see what happens stateside a little bit later on. Remember, you've got Powell coming up as Lizzy points out, at 5.20. Is he going to rise to the rescue, signalling rate cuts and everything's going to be fine? We'll wait and see what that narrative looks like later. But here we go. European stocks are down. Yesterday, the bounce that we got didn't feel convincing, and I think we have probably confirmation of that this morning. Lizzy, sectors, single stocks, what are we watching?
Three-quarters of sectors in negative territory this morning. As you suggest, you've got basic resources at the bottom of the basket. They're down 1.3%. Energy, somewhere in the middle there, down 0.2%. BP itself down 1.5%. And Fresnillo, not going to be on that list today at 8:30, Guy. It's down 1.9% off the back of these gold moves as well. Just some of those individual stock stories that I was flagging. Publicis had those great results, actually, because they raised their growth outlook because of the strong ads and the AI demand. But actually, those shares on the CAC down 0.6%. So really, this risk-off mood penetrating many of the sectors this morning.
Yeah, we seem uncertain about a lot of things, don't we, this morning? So basic resources on the back foot, partly because all the sort of frothy precious metal trades have rolled over a little bit. We're flat on the gold price. The silver price is down by over 1%. We're taking a pause for breath there, maybe. But then there's the more fundamental side with iron ore and copper and what's happening there on the back of the China-US trade tensions. They're weakening, and so all of that adds up to a sort of negative mess for basic resources, and that sector down by 2.3%. And where do we find solace, Guy? Well, it seems in consumer goods. That's where we find solace this morning. Unilever, Tesco. Low-value consumer goods.
Safety.
Yes, I was going to say ice cream, and then I couldn't remember whether that still included ice cream. But anyway.
It's in the process of melting or being spun out. I'm not sure that there's an ice cream joke there. Bellway is up this morning in the house building sector, which I think is interesting. It's out with a statement this morning. In terms of what else you are getting, Givaudan is rising on the back of what it has to say in terms of the fragrances and flavours business that it works in, which maybe takes us back towards that safety trade. Nokia's up as well. Trust you where Ericsson is, but Nokia is tracking a little bit higher. Kind of feels like a bit of a reversal of some of the other stories that we've been watching over the last few days. Some of the car stocks are coming back a little bit. They've been badly beaten up. So as you point out, Anna, I think it feels like a market that is rotating towards safety.
Well, let's get some analysis now. Joining us around the desk, I'm pleased to say, is Kate Moore, Chief Investment Officer for City Wealth. Good to have you in London.
Yeah, it's wonderful to be here.
I want to take the temperature. So today, we all came in optimistic, and yet we have European equities all in the red and US futures also pointing lower. NASDAQ futures down more than 1% at the moment. Yeah. It's looking like what we saw earlier in the week wasn't just a blip. I'm wondering, is it Liberation Day in slow-mo? How do you characterise the tariff threat's impact on these markets?
Yeah, so I think there are a few things to keep in mind here. Of course, we're kicking off U.S. earnings, the large cap earnings in earnest today with a bunch of the banks, and that's going to be really important for sentiment. So I think from an investor's perspective, everyone is very, very focused on the guidance and the commentary from U.S. management teams, especially since we've continued to reach new all-time highs, what felt like on a daily basis over the course of 2025. So I think that's important in weighing on sentiment, and people are in a wait-and-see mode, perhaps take a little profits. But the tariff side is really important. And I've been saying for the duration of 2025, or at least since the April 2nd tariff announcements, that we are past perhaps tariff shock, but not past tariff pain. And I think that the President of the United States will continue to use tariffs as a negotiating tactic with all of our trade partners. We saw this, of course, with China on Friday. It is not going to be off the table for the duration of this administration.
Yeah, and I mean, there's so much focus on those earnings in the absence of government data because of the US government shutdown. But I wonder, on the tariff point, is it too soon for clarity on the impact of tariffs on companies' bottom line, given that, as you say, the US-China tariff spat is ongoing?
Yeah, so this is what I will say. This is where taking alternative data into your process is even more important than ever, because some of the official data doesn't tell the true story. And one piece of data I've been anchoring to has come from a Harvard Business School study. There's been kind of a scraping they do of the internet and like looking at all these major U.S. retailers and kind of saying, what's happening to prices. And for many of the imported goods, the prices have risen sharply over the course of the beginning of October, even as we haven't had official economic data. So I'm watching these third-party data, which is indicating basically that inflation is percolating once again. And I think that'll make the decision for the Fed that much harder as we go through the fall.
You talk about tariffs, and it seems timely to linger on that conversation a little bit, Kate, given we've had this news flow overnight, which once again catches our eye around China, the United States. So you draw a distinction between the shock and the pain.
Yes.
Is the pain less when there's no shock? I'm trying to work out whether we have a sort of reduced reaction function to tariff headlines.
This is what I will say. We actually had this conversation last week on the team with some of our counterparts on the street, et cetera. People were just not talking about tariffs at all. I was trying to get a pulse of, all the traders and everyone's in the markets business, and they were saying no client really wants to even talk about tariffs. They're thinking it is, in the past. And of course, this comes up on Friday, reminding everyone it's not just in the past, it's in the present and potentially in the future. So I think there was complacency around the impact that tariffs could have on overall activity and on price levels.
Yeah.
And I think we're likely to see some impact, especially at the low-end consumer in the U.S., of higher prices into the back end of this year.
Yeah. And so when you talk to wealth clients then, when you get the temperature of what they're thinking, do they feel the need to protect themselves right now from either tariffs or, maybe AI bubbles bursting? And if they do, where do they go? We had a great conversation with Evie Hambro from BlackRock earlier. Yes. His view is that the rally in metals is all about fiat currencies being on the wane. I mean, is that the conversation amongst wealth clients?
So I would say throughout the course of this year, there have been lots of concerns our clients have expressed. In general, they've seen markets at new all-time highs consistently, especially since the April lows. They've looked at inflation percolating not just in the U.S., but everywhere else. Geopolitical tensions on the rise, notwithstanding what happened over the weekend in the Middle East. And I think it's made people a little bit anxious. The dollar weakening and emerging market equities all happening at the same time is kind of tearing people in two different directions. So our clients have wanted to do a number of different things. Number one, they wanted to really kind of rethink their dollar exposures. I think that makes a huge amount of sense in this environment. Number two, they want to stay geared to the AI trade, but they want to do it in a kind of more cautious way because they're afraid of being all in and having a very concentrated exposure and then perhaps getting some news flow that suggests the AI spending and infrastructure build out is slowing and then, taking that on the chin. And then they're having a lot of conversations with us about what they want to do in fixed income because long duration bonds anywhere in the world don't look very attractive. And we've been shorter duration like everyone else on the street, but people are getting uncomfortable with that concentrated position.
Okay. I'm trying to put it all together.
That was a lot.
There was a lot. So I'm just like, let's kind of.
Yeah.
Powell speaking at 5:20 today.
Yes.
Is he going to tell? If he's listening to Kate Moore this morning, it sounds like he's going to be going, yeah, I'm not quite sure I want to be cutting rates right now because inflation's coming back.
I don't think it's a slam dunk, to be honest with you. I mean, I think the Fed is going to have to continue to show that it is data dependent, assuming that we get government data in advance of them making decisions, and that they will have to continue to be disciplined about assessing the current environment and adjusting their forecasts. At this point, I don't think an October rate cut is a slam dunk.
What are the implications for equity markets if that's the case?
I think there are parts of the equity market that are banking on consistent every single meeting a rate cut. So we could see some indigestion, let's call that.
That's a very polite word.
Yeah. Thank you. Thank you. I've had enough tea this morning to remember to use my polite words.
Took you a while to work that one out, but it was.
What does indigestion look like?
I think indigestion looks like some of the rate-sensitive stocks are those that have benefited the most from expectations of a consistent rate cutting cycle may cool a little bit. And like the U.S. labor market has been frozen, but it's not deteriorating rapidly. And the inflation story percolating makes it hard for the Fed.
Which is the bigger threat to my portfolio right now, inflation or growth?
I think inflation.
Okay, that's interesting.
Yeah, I think
because people aren't talking about it. People are definitely focused on growth.
Yes.
It's like.
We don't see a significant deceleration in economic growth at this point. A cooling in economic growth next year, but not a deceleration that's scary or nothing close to a recession. Not in the U.S., not in Europe, not in the UK. That's not our base case. That said, of course, there are things that could shock the system, and we'll be watching the data very closely. But I'm more worried about inflation having an impact. When we get the data, I'm more worried about inflation having a greater impact, particularly on lower-end consumers. The high-end consumer can't continue to hold up the market forever and ever and all consumption. So.
Well, speaking of the data and the lack of it and the root cause, the government shutdown, I'm looking at Polymarket odds of it going beyond 30 days, 65%.
Yeah.
I do wonder how long it has to go on for that to really knock the stock rally.
Well, what I'm interested to see is what kind of pressure is put on representatives in Congress the longer this goes on.
Yeah.
And, you know, the public right now is not screaming. They're not saying anything is wrong with the government shutdown. Most of them don't feel it in their everyday life. But if they get to the airport and their bags don't get screened, or if basic services are not rendered, or if we have government workers calling in sick because they're just tired of not getting paid. Those are things that could really change the pattern and put pressure on representatives. We're not seeing that yet. And so, unfortunately, I understand why the poly market odds are extending to a longer and longer shutdown.
But you have got people being laid off instead of furloughed. Is there not a risk that that leaves scarring and actually wobbles your growth outlook?
I think for certain segments that will definitely could potentially have an impact. But what I will say again is the high-end consumer is holding up well. I don't know if they can forever and ever, but at this point with asset prices higher and people feeling wealthier.
You saw the Delta numbers last week were just like Ed Bastian saying we're good to go here.
And I watched the airlines and these kinds of discretionary spend areas really closely. When there was that whole period where all of the airlines were saying all of the spend or all of the growth was coming from business travel alone, that made me anxious. But now we're getting, you know, more discretionary spend. And frankly, we're getting a little bit more travel from the average consumer. So we'll watch this. Look, here's what I will say. There's a lot for us to focus on going into the end of the year. And there's a lot of reasons for us to stay on our toes, given the fact that markets continue to reach new all-time highs in the U.S. But this earnings season, as I started my commentary with, is going to be really, really important for sentiment. And we'll be watching not just what companies say about what happened in the third quarter, but their expectations not just for fourth quarter, but for next year. Right. And that this is the time for them really to reset.
That sets up my final question, Kate, so nicely. It is about earnings. I was looking at, I think it's a Citi chart, in fact, of earnings and earnings revisions. And it was suggesting at the beginning of the year, a lot of earnings revisions to the downside because of around April, the tariff threat. And then since then, we've been ramping up expectations, but now it's sort of flattened. But maybe we're just done and waiting for the detail and the disclosure. So how are we set up going into this? How high are expectations?
Yeah, so I pay very close attention to earnings revision ratios, and I look at not just the 3-month, which is what a lot of people look at, but also the 1 month relative to the 3-month. I think this is critical because we've seen actually 1 month relative to 3 month in every single region weakening going into earnings season. And these revision ratios, remember, are 12-month forward, not just for third quarter reporting or fourth quarter. And, you know, after revising up, after that very negative sentiment at the beginning of the year, people are realizing that growth is going to be okay, but not phenomenal. I would expect that kind of full year 2026 numbers are a little bit too high. Analysts always start off a little too high. And that's why this earnings season kind of resetting from companies is going to be incredibly important. So not catastrophic. We're talking about positive earnings growth, but maybe not as lofty as current estimates stand.
Kate, great to see you.
Yeah, thanks for having me here.
I'm glad the new gig's going well.
Yeah.
Enjoying it?
Loving it.
Excellent. That's what we like to hear. Kate Moore, Citi Wealth, CIO. Thank you very much indeed. Let's take a look at the Core 6 this morning, figure out what is happening. This is the picture that we find ourselves with here in Europe. As you can see, there's a fair amount of red on the screen. Remember that LVMH is going to post numbers just after the market closed today. Keep an eye on what is happening there for sentiment in the luxury sector. But you've got a broad-based sell-off happening here. Defensives doing better. Look at Nestle, up by 0.7%. What else do we need to be watching this morning? Some quite big moves. Ericsson is certainly one of them. Chloe, Melly, over to you.
Good morning, guys. So, yeah, a really, really positive move in Ericsson this morning, up more than 10% on the back of its earnings this morning, and reported a third quarter profit that was that beat estimates, and that was also a massive jump. And that is a lot of that has to do with the sale of its business iConnective. It also struck quite generally optimistic tone and said that it made progress in improving its margins. So this is quite a welcome relief for Ericsson after the weak dollar and then also weak demand for 5G equipment, for telecom equipment, really weighed on the shares over the last few quarters. So a really positive movement for Ericsson this morning. Moving on to a more negative story, and we have got Michelin down 9% and also dragging down Continental this morning, down 3.5%. Michelin cut its outlook due to really weak sales in North America, and this is something that analysts have said maybe it indicates a broader risk, broader weakness for that tire market, especially in that region. And so we are seeing a very big downward moves here for that sector. Continental is also refocusing on being a tyre-only business, but it seems maybe that was quite a difficult time to be doing that. Moving on to Bellway, the house builder, the UK house builder, it flagged quite weak consumer sentiment, but it launched a £150 million buyback program, and that is being reacted to very positively by the market. It is up 4% this morning for Bellway. And finally, Klépierre, which is a French property management company, was double upgraded this morning by JP Morgan from an underweight rating all the way up to an overweight rating because of prospects brightening for that company. And we are up 1.6% on the back of that upgrade.
Chloe, thank you. Chloe Melly from our equities team with a look at some of those stocks on the move. Coming up, another stock in focus this morning, EasyJet shares on the move this morning on reports. This from Corriere della Sera over in Italy, that a particular suitor might be mulling a bid, even though the report says that they've denied it. But the stock is on the move, up by 6.4%. So we'll get some analysis of that and other things moving the aviation sector. This is Bloomberg.
Tuesday morning, good morning. 20 past, approaching 20 past. Equities are down, and down quite hard, actually, reflecting really what we saw in futures as we've seen effectively the trade war story being repriced back into markets. You see it in US futures. US futures are down pretty hard. European equity markets are opening down pretty hard as well. Despite this, there's some actually quite big single stock moves today, which are really worth paying attention to. Take a look at what's happening with Ericsson. Shares in EasyJet are also very much on the move this morning, fading an earlier pop, but still up by nearly 7%. There are reports coming out of the Italian daily Corriere della Sera, the Mediterranean shipping company, which is domiciled in Ireland, but I think is Greek, is in partnership with an investment firm and potentially taking a look at a bid for EasyJet. Now, this is not something I've heard about being talked about before. EasyJet's being talked about as a takeover target, but not down this route. Benny Camel leads our aviation space coverage and joins us now. What do we make of this?
So far we've not heard from EasyJet, so that would lead us to think that maybe it's not imminent. Normally under takeover panel rules they would have to respond with a statement, so the fact that we've not heard anything so far might suggest that it's not imminent. However, EasyJet is one of those companies, one of those airlines that has sort of been in play for a couple of years. There was a takeover approach in 2021. Bloomberg later wrote that Wizz was in fact the suitor. So this is a company that has sort of been out there. If you listen to people like Michael O'Leary from Ryanair, he keeps saying there will be consolidation in this space. He obviously thinks that his rivals, i.e. Wizz and EasyJet, are the obvious target. So it's not an impossible thing to imagine. The whole sort of take private fantasy is also out there. A lot of companies with cash out there. And then finally, you know, you might be scratching your head a bit. Why would a shipping company want to buy an airline? But MSC have been poking around that space previously. They were part of the original bidding consortium, I should say, with Lufthansa when they bought ITA, the Italian airline. They ultimately dropped out. But again, you can get a sense that this is a company that's sniffing around for potential targets, that's looking at potential companies. And Corriere, I'll have to say, are usually fairly well informed. So who knows? This might actually turn into something.
We'll see. And certainly, and the EasyJet founder, Guy and I were just remembering, has something of a shipping background as well. So that certainly got our attention. Benny, elsewhere in aviation news, we have a story that Airbus is opening a factory in Alabama. What's the impact of that?
The impact really is that Airbus has a problem that a lot of other companies would love to have, which is a huge backlog of aircraft, and they're trying to work through that. This is literally thousands of planes that they have yet to build, and they're expanding their manufacturing footprint. So they're adding another so-called final assembly line in Alabama, in Mobile. They're adding one in Tianjin in China. That gives them 10 production lines in total across the world. The biggest ones are in Toulouse, where the company is based, in southern France. There's a big one in Hamburg, but this really gives them this global footprint, and it helps them churn out the A320 family at a faster clip. That's the plane that really is the most popular one. We're seeing it take off there in the background. And the A321 is the larger version of that, and that's really the plane that everyone is buying right now. That's also a plane that takes a little longer to build. It's a complicated aircraft. So having more production facilities, that's really what Airbus is trying to do here. They want to get to 75 A320 families by 2027. They're some ways off from that right now, but opening up these additional FALs, as they're called, final assembly lines, that's going to help them.
All right, Benny, good to see you. Benedict Camel, thank you very much for that. And staying in the corporate space, but turning to fashion, analysts expect organic sales at LVMH's key fashion leather goods unit to come in lower for the third quarter due to a continued downturn in demand. The owner of Louis Vuitton and Christian Dior reports today after the close of European trading. And for more, we're joined by our Bloomberg opinion columnist, Andrea Felsted. Andrea, good morning. We're looking ahead to these results. Of course, you've got lots of new creative directors at some of the big names, including Christian Dior. I wonder how much that means that they're individual, idiosyncratic stories for the different luxury houses, or whether LVMH is actually going to set the tone for the rest of the sector.
I think there's two things. The good thing about the creative directors is people are talking about fashion and luxury again, and they're not just talking about the price increases. That's been the narrative for the last couple of years. All the prices have gone up, it's too expensive, it's priced people out. Now we've got a fresh discussion about luxury. We don't know what the pricing will be on some of these things, but the fact that it's generating excitement and interest in luxury and fashion once more has got to be a positive.
Yeah, picking up on Lizzie's question, Andrea, is it going to be that we have one, do we look for one narrative to dominate this time around, or do we think there will be, all these different stories popping up from the sector?
I think the one narrative we'll be looking for is have things turn the corner. I was in the States last week. The wealth effect is real. There's a lot of interest in luxury. New stores, the Demna collection for Gucci was in their store in Soho. It does seem to be back, and a lot of interest in luxury. What is missing is the China recovery. So I think the narrative will be, are we seeing a recovery? The US is there. Is China coming back? What's the story on China? Within that, you will get issues with you will get discussions of the brands. Really, for LVMH, it's how's Louis Vuitton doing and is Dior recovering?
Just to come back to the US, though, Kate Moore was sitting in that chair just a few minutes ago from Citi, and she's saying we're questioning how long the high-end consumer story can continue in the States. It's related to the stock market, it's related to crypto. Crypto's just had a massive wobble. You talk about it being real. Is it real built on solid foundations or real built on stock market paper wealth, crypto paper wealth?
It's luxury demand in the States tends to be correlated with stock markets. So I think as long as the market stays, then that story will continue.
Crypto wobble? That was a big crypto wobble.
I definitely think that will be an issue, maybe particularly for watches.
Yeah.
But I think it's more the mainstream stock market and that wealth effect. People are looking at their, savings accounts or investment accounts and really seeing that they are very wealthy. And luxury does well when we feel happy and we feel confident.
I've been told I should thank you, Andrea. Thank you very much. I've been told I should thank Anna as well. For some reason, I have no idea.
I'm off to a new energy finance conference.
Oh, right.
I'll be back tomorrow.
Back tomorrow. I'm still going to be here. Lizzie's still going to be here. We've still got half an hour to go. This is Bloomberg.
This is the opening trade. We're 30 minutes into today's session. And do you remember that market reaction to President Trump's tariff threat, an extra 100% tariff on China? Do you remember when we thought maybe that was a blip? It's not looking like it this morning. Red across the screen for European equities at the open. And it's pretty much the same story when you look at US futures as well this morning. This is usually the point in the programme when I would hand over to Guy and we would see that Fresnillo, the gold equity, is up again. But it's not looking like it's a gate, Guy.
No. which is disappointing in some ways because it's been such a feature of the landscape over the last few weeks and months. But today it isn't. We've got other 52-week highs and 52-week lows. Let's start off with the internal metrics. 183 up, 406 down. Volume's a little higher as well. We've got volume up on a down day, which I think is worth paying attention to. Let's talk about what we are seeing in the 52-week highs and lows. Fresenius Medical is my 52-week high of the day. It is not Fresenius, but it does start with an F. There you go. That's the one-year chart. As you can see, nice left to right move. We're up by 44%, which is great, but it's much less than the Fresenius, which the mining sector has delivered some stunning returns. At the other end of the spectrum, let's talk tyres. US tyres in particular, and this is the story with Michelin this morning. Out with a warning, the stock is down by 24%, and it's a big move lower this morning. We're kind of taking out the April lows quite convincingly. And here's the interesting story around this. So this is weakness in the heavy truck sector in the United States. There's a lot going on in that space right now, but that's an economic bellwether to what is happening in the US economy. Heavy trucks worth paying attention to. The other thing is agricultural machinery as well is where they're seeing weakness too, which again speaks to this tariff story. We know what's happening with the soybeans and what's going on more broadly with the agricultural space right now. Pay attention to that as well, because that's where you are seeing weakness as well. Is that something you want to extrapolate into names like John Deere as we work our way through the US earnings season, which again is a sort of key stock for that reporting season? Anyway, Michelin at a 52-week low, down hard this morning. Lizzie, what else do we need to know?
Well, here are some of our other top stories this morning. China has threatened further retaliatory measures against US curbs on its shipping sector after sanctioning American entities of a South Korean shipping giant. The Ministry of Commerce said that it was placing limits on 5 US units of Hanwha Ocean, one of South Korea's biggest shipbuilders. The company's shares dropped as much as 8% in Seoul, their biggest decline in about 2 months. Elsewhere here in Europe, Sébastien Lecornu will address the French Parliament today for the first time since being reappointed Prime Minister, as his fledgling government tries to pass a budget. President Macron has called on the fractured parliament to deliver stability for the country rather than precipitate another government collapse. And silver, as we say, is trading lower after touching an all-time high above $53 an ounce as a historic short squeeze in London added to momentum fueled by surging demand for safe haven assets. Gold also paired gains after climbing to another record high, building on 8 straight weeks of gains. Guy.
OK, let's take a look at what we are seeing in terms of the crypto trade this morning. It has been a brutal few days, to be honest. And in some ways, Bitcoin has been an area of calm because it's been some of the altcoins that we've really seen being battered. But you saw huge numbers of liquidations Friday into the weekend. You've only got to see what is happening with your Twitter feed right now, your X feed right now, absolutely blowing up with all of the commentary around what is going on here. So let's figure out what is going on here. Elsie Susie Watts, Executive Director, Global Digital Finance, joining us from Washington. So thanks for the timing. Elsie, let's talk a little bit about that. Well, let's talk a little bit about what happened over the weekend. People are talking about this as being a kind of key moment, that actually this is going to be something that is with us for a while, that actually it's not going to be a short-term blip, and that the market isn't going to recover kind of quickly. What's your sense this Tuesday morning of where we are after a brutal few days?
So I think as you were talking about, the traditional markets a little bit earlier as well, you can still see that crypto is a little bit down this morning. And I think, though, actually what's interesting here is that this is actually not a crypto specific event. This is, as you were talking about the tariffs, a policy induced liquidation cascade. And again, I think the timing is really telling here. The market was already quite nervous about, rates, deficits, liquidity. And then when we saw Trump's Truth Social post, as well as other tariff related news last Friday evening, that's when we really started to see that big tumble in crypto markets. But what I would actually argue is really interesting here is compared to previous incidents of volatility, this time the crypto market actually had a much quicker bounce back, noting that I think that there is that structural support there, which wasn't there previously, such as ETFs, corporate treasuries, more institutional trading desks, which are now involved in crypto. And so it's a bit more resilient than it has been for volatility incidents in the past.
So, Elise, you don't see, I read a lot about lasting damage, late cycle. These are kind of the phrases that are being thrown around at the moment. Lots of liquidations, a lot of people being pulled out of the market, a lot of people struggling to recover, therefore. So still see this as short term, whereas what I'm reading elsewhere is suggesting that this is a much longer lasting effect that will be felt for weeks, if not months.
I think that it's fair to say that it's a lasting effect, but I think you also need to separate out some of these various parts of the market and certainly separate out what we're seeing from the altcoins versus from what we're seeing from Bitcoin, for example. So I think that you can still argue that Bitcoin, despite its volatility over the weekend, it has recovered and it is still a risk-off expression in some ways. Not the same as gold, and obviously that gold comparison is, drawn on quite a bit. But I would argue that probably Bitcoin is not necessarily the same as a safe harbor as gold, but it is certainly very different to the altcoin market. And that's especially because of its proof of work mechanism. That makes it structurally closer to gold. It's energy-based, supply capped, costly to produce. And so the investment thesis there, as I'm sure you know, is scarcity. That's not the same for the altcoin. And of course, that then depends on value to usage, developer activity. And bear in mind, there was also a lot of leverage in the altcoin market as well, which is, I think, why you're seeing those large effects. So I think you do need to draw a distinction there as well between proof of work and proof of stake and what we would see from Bitcoin versus what we might see in other parts of the market.
Elise, part of what Guy is alluding to is, of course, the plumbing and the fact that this happened over a weekend and, you just saw how thin liquidity gets over the weekend. I wonder how much the structural issues mean that it's a long way before crypto trades like a mature asset class, and actually if there's more that can be done to help it on that journey.
So, I think that that's a fair criticism, and there were definitely some aspects of the market where we saw some failures, but what we also saw was more responsiveness and more transparency than when this has happened in the past. And I mentioned it earlier as well. I think that those, more structural elements that are closer to institutional infrastructure, the ETFs, the corporate treasuries, and the market makers that weren't panic selling, I think that still reflects that we can see the market maturing. Is it fully to a mature scale yet? Probably not. And again, I mentioned the leverage. I think that a lot, of the market was probably vastly over leveraged as well, which is why you saw some of these, really devastating losses. But equally, I think that, coming back to what I was saying about Bitcoin, I think capital market desks are still viewing Bitcoin as a bit of an asymmetrical trade there against sovereign and corporate debt. And so I think that, we are still seeing, and with the advent of tokenized gold as well, and soon tokenized treasuries, these can be bridge assets to blending that safety with the programmability that we see of crypto markets. So in short, you're right. I think the markets aren't fully as mature yet, but I think we definitely have seen a lot more maturity than when we've seen historic losses in the crypto market and volatility like this in the past.
Well, here in the UK, the Reform UK leader Nigel Farage is calling on the government to regulate the crypto industry. And I just wonder, as you survey global crypto markets, where in the world is getting the right balance between innovation and investor protection?
So that's a really interesting question, and one that I work on probably every day. I think that, as I'm sitting in Washington, D.C. this week for D.C. FinTech Week, we certainly have seen a lot of progress in the U.S. And I think that the Genius Act, which regulates stablecoins in the U.S., is a really great example of balancing innovation with, making sure those market protections are in place. Of course, we're still seeing Treasury doing rulemaking on that. And so those final rules are not yet in place. I would argue that the UK, despite Farage's comments, has actually done a good job making progress on its own framework. And we've seen the FCA progress their roadmap and a number of consultations on issues anywhere from market abuse through to, of course, stablecoins in custody. I would argue I'd call out another great jurisdiction would definitely be the UAE. We've seen a lot of progress from both Dubai and Abu Dhabi. They have a regulator specifically for crypto in Dubai, in VARA, and Abu Dhabi has done a lot of great work on both stablecoins, which they refer to as fiat reference tokens. So I think that's certainly another contender and challenger for the balance of innovation and regulation.
If we see continuing volatility, like we saw over this weekend, how much is that going to undermine the case for crypto in the near term. There's a lot of deregulation happening at the moment. But if you want to make this a longer-term prospect, don't you need to get rid of some of this volatility, which we thought for a while had disappeared, but now feels like it's back with a bang?
I would come back to what I said before. I think if the volatility continues in the crypto markets as well as in the traditional markets, then I think it's clear that this is actually a macro correlation. This isn't just some idiosyncrasy of volatility that's within the crypto markets. And I think that, perhaps what we might see in future is that institutional investors are actually using crypto as an expression of macro sentiment when they react to policy shocks, similar to, FX desks. And so I don't think that that kind of volatility in relation to policy is necessarily a bad thing. However, I will say that I think to bring more trust and confidence into these markets, then we absolutely do need regulation. We need to think about what cross-border regulation means and how to enable, deference mechanisms and reciprocity, because these really are cross-border and global assets as well. And so I think that's really the next piece of this picture in, thinking about the overall stabilization of the industry.
Okay. Elise Susi-Watts, Executive Director at Global Digital Finance, up early for us out of Washington. We thank you so much for joining us. And Guy, it's interesting, this point about crypto regulation. I was on stage at our Women, Money and Power event here at Bloomberg with the CEO of the London Stock Exchange, Julia Hoggett, and she's defending why there aren't IPOs happening in London. And she's so frustrated when you're trying to get the retail investors to buy equities, and yet all these young people just flooding to crypto because of the lack of regulation there compared to all of the regulation she feels is faced on the UK stock market.
Yeah, the barriers to entry are just lower. It's easy. But also, in some ways, the volatility is a feature, not a bug, for maybe some of those investors too. You get big price swings, and as a result of which, it's a different investing prospect to maybe investing in equities, which is a longer-term narrative. I don't know.
It might be the first time some of them felt it over the weekend.
Certainly, it was a painful weekend. You saw all of the kind of social media. The narrative was just really extreme. A lot of people getting really battered by this.
Well, speaking of a stock getting battered, ASML, not quite battered, but down 1.9% this morning. The chip maker expected to report solid third-quarter results, though, as various AI partnerships keep orders flowing. And this is ahead of Wednesday's earning release. Joining us for more and a preview is Mark Bergen from our tech team. Good to see you, Mark. What can we expect from these results?
I think it's really, ASML is a fascinating company that is now inextricably tied with politics and geopolitics. And we're seeing both their rare earth restrictions out of China and then Trump's continued tariffs. And we also saw in the U.S. Congress calling out companies like ASML for continuing to do business with China. That almost feels more significant than their quarterly revenue in some ways.
Hence the move today.
But before I ask the next question, how do I value, therefore, a stock like ASML when it is effectively being pulled and pushed by so many of these kind of massive macro themes?
Yeah, I think, there's the argument that the tariffs have been priced in certain ways. ASML is, they are the monopoly of monopolies in this industry, right? There's no competition. They are the one that is the primary equipment maker for these chips that NVIDIA and AMD and everybody relies on. Right. And so in some ways, even despite the political wins, like that, their core business is remaining pretty strong.
ASML is the kind of the critical part of this whole story from a European perspective, but Europe struggles elsewhere in terms of defining a narrative for itself when it comes to the AI story. There is a sense within Europe that it doesn't want to be left behind, that it needs to develop its own infrastructure, its own ecosystems. How possible is that?
ASML is a really interesting story there because they've actually kind of stayed on the sidelines, and we don't really think about them as European, although arguably they're the most important tech company in Europe. They recently invested, they became the largest shareholder in Mistral AI, which is the French startup kind of competing with OpenAI. In some ways, that was a really fascinating move. They described it as sort of a business strategy using their AI across their products. I think of it is a geopolitical strategy. It is, we're putting our bet behind one of Europe's few champions in this place. There's a lot more conversation in Brussels, in Paris, in capitals about sovereign AI, about actually how much can Europe be independent from the U.S. and China. Right now, very little. I think there's a varying, there's an argument for the Euro stack. In our story today, we talked about that there are politicians and there are leading figures saying Europe should actually be buying as much as possible. And you see certain countries that are now cutting out, trying to remove contracts from Microsoft, trying to remove OpenAI. for a lot of these fears and the concerns that we need to have in Europe tech independence.
When you look at the sort of investment, ASML, SAP committing billions to European AI startups, just really quickly, how big money are we talking here? Is it not chicken feed in the scheme of AI investment?
Well, that's a intense word, but it's not huge amounts, right? I think that these are SAP is the biggest software company in Europe. They've talked about spending on their sovereign AI cloud 20 billion euros over the, I think, coming maybe decade or so. Which is, I mean, look compared to what the Microsofts and Google and Amazon are spending is chump change, right? Compared to what something OpenAI will do in one day. They're a different business, and SAP's their CEO has actually come out and said, we shouldn't be trying to compete with the U.S. here. With the he wrote this op-ed in The Economist and said the hardware train has left the station. Europe's not going to compete on chips. It's probably not going to compete on that level at cloud, but it's going to have these winners in the apps and a lot of these applications in AI, and those kind of companies actually can compete on a global scale.
Thanks for stopping by. Thanks for updating. It's a great story. Definitely worth a read this morning. You'll find it on the Bloomberg terminal and, of course, on the website, etc., etc. Mark Bergen talking to us about what's happening with the chip story, the tech story. The China story gets folded into this very, very quickly, doesn't it? And we've got comments coming out currently from the Chinese officials. The Ministry of the Ministry of Finance team is out talking about the fact that the US needs to correct the mistakes it's made, US measures. I think it's talking about shipping here, talking about those measures affecting the global supply chains. It wants those fixed. It's retaliating to them. And it wants these issues resolved through dialogue. But all of this needs to be set against the fact that we have a big stage coming up with President Trump and Xi Jinping potentially on that stage. But whether or not that happens or not, we don't know. The moment the market is reacting quite negatively to all of this, you're seeing equity markets under pressure. You're seeing, obviously, some of the currencies being affected as well. Val was pointing out the fact that the Aussie's on the move. It's a big risk barometer around this kind of trade. Lots of things happening around what is happening. What did I say? Ministry of Finance, Ministry of Commerce is out with these statements, apparently, I'm being told. MOFCOM.
But look, Nasdaq futures not that much further lower than they were before these headlines out of China. We'll continue to monitor it.
We will. What have we got coming up? We're going to be talking about the banking sector. We need to set you up for that as well. That is going to be a story that we're going to be watching towards the back end of this week. The earnings season's about to get going. What are we going to learn from Wall Street? We'll talk about that next. This is Bloomberg.
Welcome back to the opening trade. We're 51 minutes into today's session, and as you can see, it is red across the screen. The risk-off mood spreading across these markets as traders start to worry again about the US-China trade spat. But we've also got a lot of earnings on the docket this week. In the lack of the economic data, more of a spotlight on these this week as well. So major US banks kicking off today with JP Morgan, Goldman Sachs and Citigroup all expected to post strong results in investment banking and trading. And we've got Charlie Wells here for a preview. Charlie, just give us the overarching narrative going into earnings season.
So look, big picture, it's positive, right? We've had $1 trillion in deal volume in the third quarter. That bodes really well for the investment banking sides of these businesses. They're expected to clip a lot of fees there. So looking like it's going to be a really good quarter. But there's a little bit of skittishness here that I think we need to pay attention to, because that KBW Bank Index, it's been outperforming the broader market over the course of the year, but it's down from September highs. And so there's a little bit of concern on the edges. Maybe expectations are too high. Maybe some of this uncertainty is eating into that sector.
Winners and losers? Talk to me about winners and losers, because you're kind of hinting at winners and losers.
Yes, I am. So look, on the volatility picture, we have seen a lot of these trading desks. We're expecting to see a lot of strength coming there. Think about equities trading, Goldman likely to come out on top. FIC trading, it's likely to be JP Morgan. But I've got a cautionary tale for you, and that's Jefferies. And we've been talking about that over the past couple days. And look, they had a great report card, right? Their third quarter revenue was the best they ever had. Look at their share price now, right? It is down significantly because of the concerns about exposure to the auto sector.
And I just mentioned about, the importance as an economic barometer of the US. what sort of window could we get into the state of the economy?
Great story by Bloomberg out about how some of the banking data could be something of a proxy for this economic data that we are not getting because of the government shutdown in the U.S. But there's a flip to that, right? We get a great picture, but also that adds more scrutiny to these earnings. I think it's going to be really important to listen to these analyst calls today as they ask executives about the outlook going forward, because I think that in this quarter in particular is going to matter a lot more than solid numbers coming forward. We're getting this great quote from Mike Mayo in a recent note about how it's all about that outlook, all about looking forward.
Charlie, great to see you again. Haven't seen you for a while. Charlie Wells on what we're going to expect from the banks. David, looks like this. ZEW will be out shortly. Earnings are going to be starting. We just touched on that one. LVMH is out after the bell here in Europe. The main event, Lizzie tells me it's 5:20. It says 5:30 on the screen here. I've got 5:20 though on the.
It says 5:20. You need your glasses, guy.
It says 5:30 up there. Look, 5:30 p.m. on the screen. It's 5:20. No, on the Bloomberg. There you go. Fed Chair Jerome Powell delivers keynote address at the Neighbour annual meeting. Q&A, yes, with moderator, 5:20. The market's having a struggle this morning, Valerie Teitel. Yeah. Is Powell going to ride to the rescue?
Well, look, it's all going to be about his assessment of the labor market. We've been in this blackout period when it comes to data because of the U.S. government shutdown. And I think the market is really going to be hinging on any comments of just what data he is looking at to have a clear picture on the U.S. labor market. So watch out for that. I think that would be very interesting in his speech. He does make this speech every year to this conference. So it's something, perhaps it wasn't, I guess, timed on the calendar on purpose. But this comes after we heard from Fed Governor Waller. We know he's the more dovish of the camp. He spoke to CNBC on Friday saying we don't need any new government data to verify the labor market is weak. In his mind, we have negative payroll growth, and to him, that is not maximum employment, and the Fed still needs to keep
So do you think, though, with the market down as it is at the moment, and the market is jittery, that Powell is... does he change the narrative?
Surely he needs to. If the expectation is 3.1% inflation when we actually get it on October the 24th, and all the indicators that Kate Moore was talking about earlier, surely he needs to sound more dovish. More hawkish.
But if he sounds more hawkish, heaven knows what's going to happen with equity markets later on today.
Can the AI trade handle that today? Yeah, no, that's a good question. But it comes after we also heard from a new Fed president, the Philly Fed president, speaking to the media for the first time yesterday. This is Anna Paulson.
She doesn't vote until next year.
She doesn't vote until next year, until 2026, but mark her down as a dovish voter. She was mentioning that the AI infrastructure trade is masking broad weakness in the U.S. economy. She's in favor of 2 more rate cuts this year, and then went on to say that she thinks the U.S. economy right now is too weak to generate sustained inflation off of tariffs.
That's not what we heard from Kate Moore earlier.
Nope.
She was certainly hinting at the fact that we are still going to see inflation coming through, and she's worried about it, and she thinks I've heard it twice today, coin toss on what is happening in terms of the Fed rate cuts that we're going to get the back end of this year.
Well, there is Q&A today, so Powell might be asked about these recent flare-ups of U.S.-China trade tensions and what he thinks about that. Will he answer with something inflationary, or will he answer with something about negative growth? Because we have seen a pretty decent Treasury market rally on the back of these U.S.-China tensions. It's taking place today, so Treasuries are a safe haven. It's back.
You heard it here first. Valerie, US futures are really negative, though. You've now got the Nasdaq down by 1.1%. That's what we're going into in terms of the session. That's what Powell's going into in terms of the session that he's looking at here. That wraps things up. Hope you enjoyed the show today. We had some great guests and great commentary. We'll do it all again tomorrow. The opening trade is done. The pulse is next. This is Bloomberg.